Hello everyone, in today's video we're going to take a look at pre-year-end tax planning. And I'm not talking about pre-company year-end, I'm talking about pre-fiscal year-end, the tax year, the income tax year in the UK, which runs from 6th of April to 5th of April, so just round the corner. So what can you do to get your income tax down? Well, first thing, pay into a personal pension. So, income tax versus corporation tax. Now, like I've said, this is all about income tax, but you may be a owner of a limited company, a director shareholder, so you've got both corporation tax and income tax to worry about. Now, if you are a director shareholder, and typically you might be paying yourself what we call the optimal remuneration strategy, that of minimal salary, maximum dividend. Let's say there's you and your spouse as director shareholders. You could get 100 grand out of the company on about £7,500 tax leakage. That's a great effective tax rate, 7 or 8%. Taking your salary to get your credit for your state pension, and the rest is dividend, not exceeding 50,000. So if you are doing that, you and your spouse in your limited company, then I would suggest you don't have an income tax problem. So because that's a great strategy. You're only paying 3.5, 4 grand tops on 50 grand. Can't do much better than that. Chances are you've got a corporation tax problem and you're making a few quid and you want to get your profits down, then you do a corporate pension contribution. But now we're assuming, for the purposes of this video, look, you're not an owner, you're not necessarily in that scenario. For whatever reason you are, you have an employee somewhere, and you have a large salary, or for whatever reason you are an owner, manager, director of your own company, and you're not on the optimal remuneration. The point being, all of a sudden, the shift changes from being a corporation tax problem to an income tax problem. So then you'd look to do a pension personal contribution, but you've got to do it before the 5th of April. You can't carry back pension contributions. So annual allowance is 60 grand, plus you've got the carry forward from previous years if you haven't used your annual allowances in the previous few years. So pensions pre-5th of April for an income tax saving, all right? And especially when would you do this? You do this to get out of certain tax brackets. So I don't know, let's say you are on a salary, you work for someone else, and you're on 55 grand a year salary. So 5,000 of that is going to be taxed at 40%. You say, well, how do I get out of that dreaded 40%? Well, one of the ways is to do a pension. If you do enough pension to take you back adjusted earnings to 50,000, you're not going to be exposed to higher rate tax because you're going to get higher rate tax relief on that pension contribution. Likewise, if you on a job, you're an employee and you're earning just over 100,000, again paying into a personal pension get you back down to 100. Restoration of the personal allowance, which as we know is clawed back once you exceed 100 grand of income. All right, so pensions. Next one's ISAs, 20 grand a year. It's been that limit for quite a few years. There's talk, rumor that the fiscal statement, the spring statement, the mini budget, call it what you will, which is happening on the 26th of March, will curtail investment choices in ISAs. There's talk of possibly not only the limit coming down, maybe the amount at which you can put into cash ISAs is going to be restricted. Because at the moment you can do the whole 20 grand into cash ISA or stocks and shares. There's talk about restricting what you can do with cash ISAs. So the tip today on that is ISAs, if you're going to do your annual allowance and you haven't, do it now. Don't even wait until the 26th of March, even though technically, you might think, well, we've got till 5th of April, but I would do it now because you never know what is in that budget next week on ISAs. Okay, venture capital trusts and EIS. So let's say you're doing your pensions and your ISAs and everything else. You say, you know what, I'd still like to knock a few quid off my tax. What about investing in VCTs? Now, VCTs are typically a basket of smaller startup companies. You spread the risk, and it's deemed to be a riskier investment, so you need to speak to a financial advisor about it. But the quid pro quo from the government is say, look, if you're going to take this investment risk on, we'll give you a tax break for your troubles. And that is an upfront tax relief, and tax reliefs thereafter whilst you hold the investment. So the upfront tax relief, 30% credit against your income tax bill. So let's say you put 10 grand in one of these VCTs, that's going to knock 3 grand off your income tax bill. Now, assuming you're just on PAYE, then that will result in a tax refund. But you can be on any kind of income composition that you have. It's open to anybody, but I would suggest you need to be a reasonably sophisticated investor to be investing in these sorts of things. But nevertheless, tax breaks are great. So 30% credit up front and then tax-free dividends for several years that you hold it. And then after 5 years, you can sell. If you sell within 5 years, you get that upfront tax relief clawed back. But at the back end, 5 years, sell it, no capital gains tax, like there would be on a regular investment in stocks and shares, say a FTSE 100 stock. EIS is a very similar type of investment in terms of the tax breaks that are available. No tax-free dividends on EIS, but you do get 30% credit up front and no capital gains tax at the back end. And the good thing about EIS is you can elect to carry it back. So let's say, you watch this video and you go, right, I want to pile into an EIS, but I'm running out of time, and you don't get to speak to your financial advisor until after the 5th of April. All is not lost, because with an EIS, you can elect to treat your investment as being carried back to the previous tax year. So, for example, if you managed to do one of these in June or July 2025, and then you looked at your tax return, you said, I wish I'd have done it earlier. Well, all is not lost. You just tick a box to say, let's just assume we had done it earlier, and it'll be put on your 24-25 tax return, even though it was an actual 25-26 investment. So EIS, a good thing for saving tax. So just an overview there on some of the things you can do pre-tax year end, not corporate year end, income tax year end, 5th of April. Has to be done before the 5th of April, before the 5th of April, before EIS, maybe afterwards, all right? If you like this video, please do subscribe, and as always, I'll see you soon.